battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
Ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Episode 122 of the show. It is called Stocks Can Keep Going Up. We will get into that in just 1 second. I do want to remind you, though, of a number of events that are coming up soon. Get them on the calendar. Save the date. Put the time on the calendar. We've got September 7th, our Wealth Insights Forum at Gibson's Steakhouse in Oak Brook for a lunch with Dr. Jeremy Siegel, the legendary Dr. Siegel, I should say, author of Stocks for the Long Run, an absolute just giant in the financial services business. You can't miss him. Stocks for the Long Run, Dr. Jeremy Siegel of the Wharton School, Wisdom Tree Asset Management on September 7th at Gibson's in Oak Brook. We've got September 20th, couple weeks after, where we are coming to you in Houston. So all of our Exxon, Chevron, and BP and Shell people, get it on the calendar. We are celebrating our newest office that recently opened in Spring, Texas, right across the campus from ExxonMobil. So join us for happy hour on September 20th at 4 p.m. I think we'll be there till about 7. We'll send you an invite very soon on that. That is coming up. And then, of course, quickly approaching November 14th and 15th. At the end of the year, we are doing our Investor Day Rebalance Due Diligence event. If you're coming into town, get on the room block soon. It is going to fill up very quickly, and we have had just a wonderful deck of speakers in the past. This year will be no exception. We've got a whole lineup coming to you soon. We will be releasing the lineup shortly, so don't forget about that. Investor Day in November. We've got September 20th with you at the happy hour in Houston, and then the 7th in Oak Brook at Gibson's. Also, I do want to plug our other 2 shows. So if you enjoy the content on the weekly episode and you want more through the week, we have our Monday meeting, which is usually about every other Monday, maybe once a month, kind of when there's some news breaking. But it's an excellent show. You got to see it. You got to watch it. The first 2 episodes are already on YouTube, so go look it up. The Monday meeting featuring myself, Bon Roth, the president of our firm, and Sam Hardy. Don't miss the Monday meeting. And then we have a brand new show coming to you every Friday, and that is called Bullish, where Sam Hardy and I cover the earnings of the week, all the big corporate earnings, all the companies that are releasing their profit numbers. We cover it. We talk about it. We talk about the stocks. It's not investment advice, but it'll give you a little idea on how we manage the portfolio. So that's what's going on at the Stenger Family Office. Get all that stuff on the calendar. We'd love to see you at these events. Watch the other podcasts. That's how we get you the data, math, and statistics, the reasons why you should stay on your financial plan and not jump ship and run for the hills. So that's the whole point of the show. You go, Nick, why are you still doing this for 3 years each and every week? Well, it is my way for a half hour on a weekly basis to get you to not abandon your long-term plan and hopefully not to sell your ownership in U.S. companies. And I will tell you, there has never been a better time in U.S. history than the time we are living in right now, where companies are the most profitable they've ever been. I think they will continue to be profitable, not without downside, not without some volatility, but this is truly one of the golden ages of being an investor. And I believe it, and we'll get into this in a second, but I believe it all started in the mid-'80s and the early 80s with Ronald Reagan and some of the policy that he released that unleashed American prosperity that we are still benefiting from here in 2023. And Bill Clinton, same thing, was forced to work with the Republican Congress and did tax cuts and some shrinking of the federal government, and some of the policy that we saw from Ronald Reagan to Bill Clinton, we are still enjoying the benefits of today. And that's what's made this just boom in economic activity in the U.S. I believe it's led to the innovation we have today that's separating us from the rest of the countries out there. So do not lose your faith in the future of U.S. entrepreneurs. That's what you have in your portfolio. Stocks can go up for a long time before they go down. And intuitively, that makes sense. If you look at the stock market and you look at the history of the market over the past 200 years, stocks on a year-to-year basis go up about 75% of the time. If they didn't, the market wouldn't have done a line like this that we all have enjoyed. And so that's the reality of stocks. There are not a whole lot of times in history where stocks produce terrible, abysmal, downward trend returns consistently. There are just times where we can end up in the wilderness, like I've called it, where the stocks kind of just chug along. They don't make massive record all-time highs like we enjoy, but they also don't fall completely out of bed and produce terrible returns either. And so when you're in these environments, you just have to pay attention to price. When interest rates are high and rising, price matters a lot more than when interest rates are falling and in the 0% zone like they were in 2020. That's what we have to be paying attention to. And that's why we do our rebalancing process. That's why we do the due diligence. That's why we pay attention to what companies are actually doing. That show called Bullish with Sam Hardy and myself will give you insight into that of what we actually think about before we buy a stock for you in the portfolio, because price matters when rates are hovering around 5.5% like they are today. So let's go back to the basics with this week's episode and article and just remember how stocks are valued. Stock prices are simply a function of earnings multiplied by price. So if you have a stock that does $10 in earnings and the market says it's worth 10 times those earnings, we multiply 10 times 10, and that's what the stock is worth. It's as simple as that. Now, obviously, there's a lot more that goes into it underneath the scenes, or behind the scenes and underneath the surface. But when we look at corporations, we want to make sure, first of all, that the E in the PE ratio is reasonable. We want to make sure that the company's growing earnings, that they're doing better, that they have some sort of business that we think's got, in accounting, it's called the going concern, which means we think it's going to be around for a while. And then we want to make sure that those earnings are high quality and it's coming from places that are actually tied to the business's core operating principles. And so that's the reality. If you buy great companies, good companies that have good earnings, and then you go ahead and look at the P, the price, and pay the right price for those earnings, that's simply market math 101. That's how we manage portfolios. In some environments, earnings can go down, they can go up, but if you see a trend where the line is going up over time, the company's stock price will go up. And so when we chart earnings long-term on the S&P 500 against the market's price, you're going to see those two lines are basically in lockstep over time. Now, sometimes earnings go up faster than price and stocks become undervalued. Sometimes earnings go up slower than price and become overvalued, but over time, those two lines even out. And so if companies make more profit over time, your portfolio goes up. It's that simple. Don't lose sight of that equation, because you're going to have to remember that next time we have a market correction. So what impacts the E? Well, it's very simple. It's companies going to work every single day and saying we can do things better. We can come up with a better product. We can improve our service. We can do a better job for customers. We can reduce our input costs. We can do a variety of new strategy. We can buy a company. We can reduce our number of shares outstanding. That's called corporate buybacks. There's a million things that companies can do. That's why we buy the best ones, because we want to go to the top companies that are run by the best management teams and say, you guys run your business, be excellent at what you do, and we're going to get out of your way as investors. We just want you to produce excellent results. And that's what we do with our proxy voting. That's how we vote proxies in the portfolio for you. We don't take a political lens. We don't try to take sides. All we say is be excellent. do a great job. And because these companies are managed by some of the just most phenomenal people on earth, they do fine. And sometimes they make mistakes. Sometimes they do what Netflix did and double down on the DVD business when they really should have doubled down on streaming. But they correct themselves and they get back on track, and things go right back to the way they were. And Coca-Cola, same thing. You saw that where there's a big debacle changing the recipe and all these different corporate strategies over time. And what ultimately happens is if you have a good company with a good management team, E goes up. Earnings go up over time. But what about the P? What about the price? And the price is what's out of your control. It's out of my control. Nobody's got any way to control price. It is subject to a million different things. The biggest factor that impacts P, the price we pay for earnings in the PE ratio, is the Federal Reserve. And that's why I've talked about the Fed. You may be sick of hearing about it by now, but I have talked about the Fed pretty consistently on the show to point out the fact that the Federal Reserve raising or lowering interest rates can really mess with the price we pay for stocks. And not just, remember, because stocks are a forward-looking indicator, because the market trades in advance, it's not just what the Fed is doing right this second that counts. It's the expectation of what they're going to do in the future that moves the market. That's why you saw in 2020 and 2021, when the Fed was at 0% interest rates, people were calling inflation transitory, the market just ripped. It just soared with the expectation that we would never have inflation ever again. We said that was wrong. We said, watch out. There is going to be inflation, and we called out the Fed. We said it's not going to be transitory, and sure enough, it wasn't. Inflation is sort of here to stay. Now, it's coming down a little bit from peak levels, but 2022, we paid the price for some exaggerated PE ratios that were thanks to the Fed lowering interest rates to 0% in 2020. And so low interest rates drive high PE ratios. When you have higher interest rates like we're in today, that's what impacts these corrections, these lower price to earnings ratios, because what people do as investors, they don't just invest in a vacuum. They have to allocate capital in the real world where there's risk-free return. Risk-free return today means you go buy a money market, for example, at a 5% rate of return. And so any stock that's not going to produce 5% in return or even 10 over the next couple years is not going to be a good buy. That's why portfolio management, active management, in my opinion, matters, because you want to look for companies that are going to be able to beat not just the rate of inflation, but the rate of inflation adjusted for volatility. So why, simply, this is what it means, is why would I go buy a stock when it only is going to pay me maybe 7% in total return when I could buy a money market for 5% with zero risk? That's the decision that every investor has to make. So remember, though, the market is this discounting mechanism, and what that means is stocks trade in advance of what's to come. So even with 5.5% interest rates, the market's not really concerned about that. It's concerned about, what about 2024? What are rates going to be then? What are rates going to be in 25 and 26? And if you look at the long-run projections that the economists are putting out now, is that rates will be closer to the 3.5%, maybe even, I saw one estimate from JP Morgan for 2026 that's showing 2.5% in interest rates by the year 2026. And so because of that, the yield curve is paying more interest. So shorter-term bonds are paying higher interest rates than longer-term bonds, because the expectation is that rates will be lower in the future. And that's the big question. Stocks are up this year because investors are really starting to believe two things. One, that earnings are going to be strong for a while, which I do agree with, so don't hear me wrong. I think companies are going to do just fine, especially large caps. Maybe not the smalls and the mids, but definitely the large caps I think are going to be just fine, depending on which ones you buy. But the real thing that investors are looking at, to me, is price. What's the right price for these earnings? And that's why the market's up so much in 2023. I don't doubt that the market's right. I don't think that the market's substantially wrong. We may have overshot a little bit. Instead of being up 20%, maybe we really only should be up 14 or 15. But I don't think the market's radically wrong when you look at earnings. The question I have, and what I've drawn attention to in the weekly articles and on the show now, is what is the Fed going to do? And if we had a crystal ball, if we could somehow get into Jerome Powell's brain for 2 minutes and see what he's thinking, maybe we would know. But I think the reality is Powell doesn't even know what he's thinking, let alone what he's going to do. And so because of that, we could see rates stay higher for longer. That's where I issue a cautionary warning of, hey, earnings may be fine. The question is, what's the right price to pay for the earnings? If earnings are strong and price is only 20 times or 15 times or 10 times, that's where the stock market could have a correction in the short run. But you can't get too bearish. We have certainly not been bearish, and that has been a great thing for our clients this year, is not going overly bearish. And so there are strategists, I won't name any names on this podcast today, you can look them up, big companies. I'm talking the biggest on Wall Street, and their strategists, their market, people out there on CNBC came into 2023 saying that earnings might be okay. We might get 273 earnings in earnings by 2025, for example. And but what they didn't realize is that the metric for those earnings, the price, they said would be 10. And so they came into 2023 with a projection on the S&P at like 3,000 points. Absolutely ridiculous. And we said that was bad math. That wasn't looking at the economy the right way. It wasn't looking at the markets and through the right lens. And so we said no. We think that earnings are going to be more like, we agreed 273 in earnings. That part was not debated. But the question was how much do you pay for them? We were closer to 16, 17. In my last estimate last year, I said about 18. That's exactly where we are today. We're actually trading today at about 19 and a half times forward earnings. That's why the market's at almost 4,600 points. So don't get overly bearish. Don't get doom and gloom. It's just that at some point here, inevitably, we will have a black swan event. That's what we call them. It's like these random things that happen that nobody sees coming, and they throw investors off their plan, or can throw investors off their plan. You saw this with COVID. And so because of these corrections, 2020, 2018, 2015, 2011, 2008, we all remember that like it was yesterday. There are these opportunities. If you've got cash, if you've got some in bonds or treasuries on the side, you've got some buying power, maybe you're dollar cost averaging because you're at work and contributing to your 401k, you have the opportunity to come in about every 3 years and buy stocks on the cheap. And it's every 3 years with almost every 3 years consistently, where some people panic and people get impatient. They think the world's coming to an end, and they will sell you their interest in America's best companies for half of the price of what they're worth. And it's just absolutely, it's the saddest thing to watch is when people get impatient, they sell their stocks, and then typically what happens is people with stronger hands that are more patient come in and buy them. And so don't be one of those people. Don't get impatient during these corrections. I would say because we had a correction in 2022, we probably have a few more years to go. Just statistically, it's not to say we couldn't have a drawdown in 23 or 24 or 25, but statistically, in a couple of years from today, we will have a pullback. When that happens, remember this warning. Please remember this episode, and just remember me saying, don't panic. Don't get off your plan. I want to call attention, and we'll end on this today, the late 90s and early 2000s, which was a slightly unique part of U.S. history. Remember, I said we came off of tremendous fiscal policy under Ronald Reagan, Bill Clinton, and in that time frame, from about 1981 to 2000, the S&P 500 produced a total return in excess of 2,300%, 2,300%. Absolutely massive. P ratios in the first part of that period from 1981 to 1997 hovered between 8 and 25. And by the way, if you can ever buy the S&P 500 at 8 times earnings, buy as much as you can. That's absolutely incredible. When it gets to 25, you go, okay, I'm a little cautious here. Let's make sure earnings catch up with price. But the bottom line is stocks were dirt cheap in the early 80s. And when my father, Ron Stenger, started our group, we were coming off of those record all-time high interest rates when CDs, some of you remember 15, 16, 17% CDs. Some of you remember 20% mortgages. When we were coming off of those record all-time high interest rates, stocks were dirt cheap because people needed a place to invest. And so finally, a lot of people like our group got into education and helping investors get out of bonds and get out of CDs and look for other places to go. And that's how the stock market really started taking off. And so again, 2,300% in that time frame. It wasn't until 1998 that earnings stagnated and prices on the market started jumping. And that is going to happen in any market. In almost every market, we end with a top, which is caused by the last group of investors who didn't believe it. They were in disbelief the entire time. They got out when things were bad and they never got back in. And then finally they felt like, oh, I'm missing out on the stock market's run. I better get in now. That's when the top comes in. We're nowhere close to that today. But in 1998, we traded the market at a 24 price to earnings ratio, just a little bit rich. In 1999, we traded at 33 times. We traded at 30 times in 2000, 28 times in 2001. And then finally, by 2002, after the bubble had popped and earnings were down, we traded the S&P 500 at 46 times earnings. That can happen. I don't think it's going to happen anytime soon. And my point to you in this article with the title, Stocks Can Keep Going Up, is we could see consistent face ripper years for a few years before a big correction. And because of that, you can't get out. I mean, imagine if you had gotten out in 1995, for example, or 1996 thinking, oh, this is going to be the end. I better take profits and sit out now. Well, you would have missed 96, 97, 98, 99. And then by 2000, what happened is a lot of people said, I've been out for 5 years, I've been out for 6 years on the sidelines waiting for a time to get in. They got in at record all-time highs, and some of them have never seen their portfolio ever return to those levels. So you got to stay invested across the entire cycle. Today at 19.5 times earnings, we feel the market is not undervalued significantly, but we do not think it's overvalued. We feel it's fairly valued. And if interest rates decline the next couple years, don't be surprised if stocks trade past the 19.5 zone, past 20, past 22. But when we get in, if we ever get into this range where we're trading stocks at 25 times or 26 or 27 times earnings consistently, just remember, there could be a bear market around the corner. That's just the market math. That's how things work. You got to know where you're at. To know where you're going, you have to pay attention to price. If you put $100,000 into the market in the S&P 500 at the beginning of 1998 and you paid 24 times earnings and held on through the peak of 2007, your annualized return would have been 7.5% per year. So don't panic. Don't get out just because of something you think is going to happen a couple years from now or because you think stocks may be overvalued in 24 months. You got to hold through the cycle because returns will actually be usually pretty strong. But what happens is if you came in 1999 and you paid 33 times earnings, your annualized return through the year 2007 would have dropped to just 2% per year rather than 7.5%. And that's why price matters. If you find the best company on earth and you think this stock, there's no way it's going to go down, you can't understand why more people aren't buying it, well, before you buy it, it may be a great company, but before you buy it, just pay attention to price. We can see these times in U.S. history, we call them lost decades, where, again, the bottom doesn't fall out. It's not that the world comes to an end, but it's just that you can get into a stock that basically produces no return. It almost becomes like a zombie company that doesn't give you return. And so that's why you got to be number one on a diversified plan. You have to have stocks in all the different sectors. You also want to own good companies that are high quality with lots of cash. It sounds obvious. It sounds like, okay, well, obviously we want to own good companies. Well, not all companies in the S&P 500 are worth owning. If you look especially at small cap companies, and that's the Russell index, I saw a stat the other day, 46% of small caps now are unprofitable. So this is what you have to watch out for. You have to be so careful before you get into just the blanket market cap weighted index or maybe your 401k where you're looking at doing a target date fund. And that's where people can get crushed over time. I had a gentleman come in for a meeting yesterday, and he has a different advisor. He wanted us to give him a second opinion. And because he is in one of these cookie cutter model portfolios that's managed by a distant third party in New York, his return has been half of what it should have been the past 3 years. The return the past 5 years is even worse. And that's because no common sense, no critical thinking was given to the investment portfolio. It was just throw it in the market and cross your fingers and hope it works out. That's not a good strategy. So get yourself with the group, get yourself to a place where there's critical thinking, there's actual thought given to what are we paying for companies, what's the right price to pay, what are the best companies. That's what we do here at the Stenger Family Office. Okay, last thing, we'll end on this. One thing to notice during the tech bubble was the S&P 500's composition. The largest stocks in 2001 in the S&P 500 were number 1, General Electric, number 2, Microsoft, ExxonMobil, Pfizer, Citigroup, Walmart, AIG, Intel, Johnson & Johnson, IBM, Time Warner, Merck, AT&T, Verizon, and Coca-Cola. Here's something interesting. In 2001, GE reported earnings of $13.7 billion, roughly 30 times on a price-to-earnings basis. Fast forward to 2022, last year, and GE reported a net loss of $64 million thanks to a series of bad managerial decisions. This is the reality of stocks, that you can go within 20 years from $13.7 billion in profit to a net loss of $64 million, that you can swing that much in 22 years if you find the wrong company and pay the wrong price. So that's my warning to you. Today's market's a lot different. We're much more comprised of big tech companies that are so ingrained in our day-to-day lives that they've got great operating businesses and great moats built in, that have a lot of cash on their balance sheet. But just keep an eye on price, because if you pay the wrong price and a company is not managed well, you could be like GE, where 23 years later, the stock is a third of what it used to trade for. So that's my warning. Watch what you're buying, get into good portfolios where there's critical thinking, and stay bullish over the long run. I believe when we fast forward to the end of 2024 and we're doing our year-end Christmas show at the end of 24, we will be looking at a market that is higher than it is today. Stay bullish, stay optimistic, and just be warned, there will be a correction at some point. Thanks for being on. We'll see you next week for episode 123.